Hello and welcome to another episode of Transforming Business with me, Marvin Schneider, where I talk about all things business transformation and specifically the kind of transformation required from the boardroom all the way down to the shop floor, the fundamental transformation required within corporates to allow them to create wealth on an ongoing basis, sustainable wealth creation, ongoing, that's an important word, in ways that enhances the well-being of the individual, the wider community, and the environment. And this kind of transformation agenda is way broader and more systematic and more fundamental than what is currently contemplated within the ESG world. In fact, I recently commented on LinkedIn on a post where someone was posting on my feed McKinsey's latest characterization of ESG, and it had three stages, from the left-hand stage, which is just, compliance, a middle stage, which does a little bit more than that, and then, what's kind of described as best practice. And McKinsey was sort of laying out some of the traits, characteristics of what they consider to be best practice ESG. And I looked at those and I thought, man, this is still very limited and linear, and it's not aspirational enough to make real change so that corporations, yes, they do create wealth, but they do it in ways that truly enhance the well-being, societal well-being. And the fundamental mindset that the board needs to have, and then backed up by the executive team, is that being in business is an opportunity to be of service to society. It is not an opportunity to exploit society. In other words, make a lot of money in whatever ways possible, even on the fringes of legality. And that's what I mean, because there are many, many businesses where they consciously or unconsciously, they operate on the fringes of legality. And you have to look at a lot of the royal commissions and inquiries and various other things to know that that's true. So the fundamental mindset needs to be, why am I in business? What am I doing? And how does that enhance the well-being of the individual, the wider community, and in the environment? You'll hear me use those three terms over and over again. It's like a bit of a mantra. And that's the first thing. And then the second thing is, and in doing that, how can I create wealth on behalf of shareholders? And that's fine. We're not cutting shareholders out of this. I'm not creating a socialist movement here. But it is using our current form of capitalism in a way that I suspect it was originally intended, but it's kind of been derailed for the last 5.5, maybe 6 decades. There's a podcast episode that I put out a couple of episodes ago on a shift in business paradigm, where I kind of talk about that. So if you want to keep up with the evolution of these podcast episodes, please subscribe to my YouTube channel. Just jump onto YouTube. Search for Valuation Insights. That's the name of my channel. And then subscribe. And I've got a playlist. I've put together a playlist so you can start right from the beginning and follow all the way through. Because this is going to be an evolution of laying out core ideas and commentary on current things that are going on in the business community. And down the track, I'd like to invite prominent business leaders onto the channel, where we can start talking about the kinds of things that they're doing in their organizations and how they're contributing to the global movement, the global transformation movement. Okay, in the last episode, I talked about the fundamentals of business valuation. And I highly, highly, highly recommend that everyone that is in a business leadership role, either on the board or on a board or in a executive team or in a senior management role for any company, whether listed or private, but particularly listed, I'd highly encourage you to take a look at that video and at least familiarize yourself with some of the basic concepts. And if that inspires you, please get in contact with me, reach out to me, and I can organize to have a briefing for your boards and your executive team on these very important topics, because they are foundational, fundamental. Quite honestly, I don't know how businesses operate without understanding the dynamics of performance as measured in economic profit and how that relates to the valuation of your company and strategy. So in this episode, I'm going to take it the next step. So now that I've laid out the fundamentals of business valuation, or the value of your firm, and I'm talking about the intrinsic value of your firm, and that value should be reflected in your share price. And it's a wholly different question as to whether the share price in the capital markets actually does reflect that fundamental value. And I'm going to talk about my view is that by and large it doesn't, which is a real problem. And I'm going to be talking about that in some detail down the track. So I'm talking about the intrinsic value of your company linked to strategy. And so the next stepping stone, once that is understood, is to then lay out the foundations of wealth creation, because I'm 100% about transforming the business and investment communities to create sustainable, ongoing wealth. And then in ways, and when I say in ways that enhance the well-being of the individual, the wider community, and the environment, my primary proposition is that in any fundamental sense, in any sustainable sense, and in any ongoing sense, the only way to do those things is by enhancing the well-being of the individual, the wider community, and the environment. And that's what people need to get. And they need to get it really quickly, because humanity depends on it, or the well-being of humanity depends on it. So let me quickly recap. By the way, this one's going to be another kind of technical conversation, so I will be sharing some slides. So let's go ahead and share some slides. Sorry, just bear with me for 1 second. There we go. Let me try that again. Sorry, I should have set this up properly a bit earlier. Okay, so in the previous episode, this was one of the key slides, so I'm just going to quickly recap. But the value of a firm that is linked to strategy can be reflected in the discounting of a forecast economic profit stream. And let me just quickly describe the mechanics to you again. This is an example, this is a hypothetical example of a company in 2021 that had a strategic position characterized in a matrix at this point here, in 2021. And it had developed internally an alternative strategy that was to shift the strategic position and create some further competitive advantage to move from this position to this position over a 5-year strategy implementation process. And then that strategy was going to play out for a period of time. And then the point about that is that historically, this company had delivered an economic profit stream, a growing economic profit stream, as reflected in this kind of line here. That's the historical performance up to 2021. And as a result, in the shift in strategy, enhancing their competitive position and market attractiveness, the economic profit stream to be delivered from 2021 forward was going to improve over a 10-year forecasting horizon. And then the forces of competition will drive economic profit down to zero, as is described in economic theory. And so I'm just invoking economic theory that allows us to construct an economic profit stream, discount all of those to estimate the value created. When you add that to the opening book value of equity, that gives you the intrinsic value of the firm. That's how this works. And it's a really powerful valuation framework. And I've developed a whole bunch of technology to make it very easy for people to do this. So if you're interested in this, please get in contact with me. It is my bread and butter. Okay. So I want to move now on to what wealth creation is. And I want to ask a question. How many people in the audience would understand that if I know the value of a firm today, then that value is expected to grow over time? Do people understand that concept? And so another way of saying that is that if the share price reflected in my company is consistent with the intrinsic value, that share price is expected to rise. And the mere fact that it rises isn't a reflection of wealth creation. It's simply reflecting in the share price 1 or 2 years in the future what was intrinsically embedded in the share price, today. So that's one of the fundamental concepts that people need to get on top of, is that wealth creation, and I'm going to describe it in this slide. So if I measure the value of a firm, the intrinsic value of a firm in 2021 as being, let's call it $1 billion, and I've assessed that using the valuation technique that I've described in the previous slide. If the cost of equity is 10% and there were no net dividends over the next 2 years, then the value of this company is expected to be $1.2 odd billion in 2023, so in 2 years' time. And that simply reflects the cost of equity, because the cost of equity describes the returns that shareholders expect to receive in order to be wealth neutral. That's what that means. That's what the cost of equity is. The interesting thing is that a lot of people don't understand that. And even a lot of people whose profession it is to be, in the investment community, a lot of people don't understand that nuance, that's what the cost of equity means. The cost of equity describes the returns to shareholders in dividends and share price gain expected over time. So then what is wealth creation? Well, if I know what the expected value is going to be in 2 years' time, then if I then measure the value of the firm in 2023, and if it's higher than that which was expected, we would create wealth. If it was lower than what we expected, we will destroy wealth. And if it's in line with that which is expected, it'll be wealth neutral. So the wealth creation will be zero. So technically, the term wealth creation means something very specific. And it means you measure it over time. So it's something that you measure after the fact. And you measure it by assessing the value of the company and comparing it to the expected value of the company at the same point in time, so 2023 here. That's what wealth creation is. And particularly wealth creation, what I'm interested in is wealth creation derived in a fundamental sense as a result of the board and the executive team doing things to cause the value of the company to be higher than what it was expected to be, through doing things like adjusting the strategic position, investing in profitable growth, undertaking operational improvement, and implementing tactical initiatives. This is what companies do. They manage the strategy of the firm, the operations of the firm, and the tactics, the day-to-day, week-to-week, month-to-month tactics to make sure that they're on track in delivering the promised value outcome. And so, every board and every executive team should have as the top of their KPIs, if you like, the capability doing the kinds of things at a strategy level, at an operational level, and at a tactical level to cause the value of the firm to increase over time in excess of that which was already expected. And that's the important point. And that's what wealth creation is. So my point on this slide here is that there has been a well-developed, systematic, structured, and deliberate approach to value uplift for more than 30 years. And my previous consulting firm, which was then called Maricon Associates, but I think they've now rebranded to be Maricon, they kind of put together a framework or a structure that helped, and their entire consulting offer was to help companies do this in a structured, systematic, deliberate approach. And so I've just sort of adapted some of this a little bit, and we'll see how that can get played out here. But there is, let's just say that most large organizations have a number of products and services that they use to serve a number of customer segments. So if I can understand the strategic position of each of the segments in which I operate, and some will have an advantage strategic position. In other words, they're operating in attractive markets and they have an advantaged competitive position because they've got a differentiated offer and or an advantaged cost position. That's what competitive position means. So there will be some segments that will have an advantaged competitive position. Some will be disadvantaged in the lower left-hand end of the matrix. But the important thing is to undertake the analysis, the strategic analysis, to understand where your business and parts of your business are positioned. So here's the advantaged segments here, the disadvantaged segments, and then there will be other segments at various points of advantage and disadvantage. So once I've got that strategic characterization, the next step is to convert that into a financial characterization, and particularly a financial characterization in economic terms. So on the vertical axis here, I've got economic profitability. On the horizontal axis, I've got the proportion of capital or equity invested in each one of these segments. And of course, the area of each one of these bars is economic profit. And so if I can characterize my portfolio of either businesses, products and services, even better segments in this way, I've got a strategic and a financial characterization of my business at a disaggregated level. And the name of the game, the way that you create wealth, is by making the area of these bars bigger, because it's more economically profitable over a longer convergence horizon. Therefore, they're more valuable than they are today as a result of some strategy shifts that I'm doing, or making these red segments less red, right? So there are two ways to create wealth in a fundamental sense. Make the economically profitable segments more economically profitable or bigger, so either grow them or make them more economically profitable, or shrink the extent to which the value destroying parts of the businesses contribute to the overall value. That's the way this works. And again, this is a characterization or an adaptation from the book, The Value Imperative, which was a book put out by Maricon, McTaggart, Contis, and Mankins in the mid-1990s, I think the book was published. So strategy has two fundamental elements. A thing called participation strategy, and you can even just think about this as corporate strategy, which is basically in which markets am I operating or competing in, right? And so the strategic options around participation is entering new markets, improving the economics of the markets in which I'm operating, or exiting markets. And a lot of M&A kind of work gets done here. In another episode, I'm going to talk about my views on M&A and how it gets abused for various reasons. It is important that companies, boards, and executives do from time to time operate in this space. But to be honest, it is not the main game. And in my transformation agenda, I actually add a third leg, which is a lot of these participation options need to be dominated in entering into products and services and markets in ways that enhance the well-being of the individual, wider community and environment, and transitioning out of old paradigm legacy parts of the business. And that's going to be really challenging and confounding for a lot of boards, because in a lot of ways, the name of the game at the top board level is recognizing which parts of the business are fit for purpose, which ones aren't, what kinds of products and services do I need to create the platform going forward, and which parts of the businesses, what do I need to exit? What are the legacy parts of the business that I need to exit? And I think one of the things that's going to shock a lot of people is that my sense is that 99% of at least listed companies are probably currently operating in some parts of the business which probably won't be part of a future going forward in the new business paradigm. And one of the things that they're going to be confounded by is how do I systematically exit those things over time, and then how do I create the new platform, the new business model that is going to be fit for purpose. So the next part is the value imperative, called it competitive strategy options. I think of this as being business unit strategy and this being corporate strategy. And, a lot of the big consulting firms, McKinsey, BCG, Bain from time to time, a lot of them sort of traditionally have operated here, but increasingly they're starting to operate here. And I would say there's still quite a long way away from fully understanding how to operate in the new business paradigm. And I'll address that in a separate video. But this part of strategy is all about what products and services am I going to be offering, and what is my business model to operate those, which is basically the cost structure and the asset structure of the strategy, and how do I price promote and make sure that I generate the revenue stream required in order to make this offering valuable. That, to me, is strategy. That's the kinds of things that boards and executive teams should be spending a lot of their time on. Now, unfortunately, my observation, having worked in this space for 2.5 or more decades, is that a lot of boards do not spend anywhere near enough time on addressing the really important strategy options. They spend way too much of their time on compliance. And as Colin Mayer in his book Prosperity laid out, I think this is a really great quote. The purpose of governance, he said, is the governance of purpose. It's a cute phrase, but it's very true. And purpose needs to be a purpose embedded in a noble intent to enhance the well-being of society at large. In other words, to be of service to society. That's the new paradigm that we're going to be operating in. And so that's the fundamental shift that we need to address. And so, yes, boards spend not enough time on these fundamental strategy, managing the strategy and participating in the development of strategy. And the executive team spend way too much time on tactical, operational, day-to-day things. And in another video, I'm going to talk about the real opportunity to uplift the goings-on at both the board level and the executive level. All right, let's move on. So you've heard me use the term ongoing, on an ongoing basis a lot. So here's the truth about ongoing wealth creation. All right, so let's start with the left-hand side of this layer, which I laid up before, right? So on the left-hand side, in 2021, the firm was worth $1 billion in an intrinsic value sense, and it was expected to be worth $1.2 trillion 2 years later in 2023. So imagine that the value of this business ended up being $1.4 billion, which is higher than that which was expected as a result of the deliberate combination of strategic, growth, operational, and tactical actions. In other words, this company was successful in doing the things at a board and executive and governance level to cause the value of the firm to be higher than what it was expected to be. Good job, well done. Here's the kicker. Here's the kicker. Starting from $1.4 billion in 2023, in 2025, which is 2 years now into the future, the value of this firm is now expected to be some $1.7 billion. And so unless the board and the executive again undertake a deliberate combination of strategic, growth, operational, and tactical actions to cause the value of the firm to be now higher than $1.7 billion, then they will fail to create wealth in the 2 years from 2023 to 2025. And so here's the kicker, and this is really important. And let me just quickly stop sharing screens while I kind of talk to camera on this one. So the really important thing about ongoing wealth creation is that you don't get to sit on your laurels. It's not a do it once and I'm okay kind of thing. It's an ongoing, relentless, deliberate pursuit. You have to do it today to create wealth in the upcoming measurement period. And then you need to do it again and again and again and again. And it's only those really well-managed companies that are able to do this in any fundamental way. And the vast majority of companies are not geared up to do this. And so institutional investors who, by the way, want you to create wealth in a sustainable way on an ongoing basis ought to be a little bit concerned about this, because at the moment, by and large, any wealth creation outcome that is observed in the capital markets has some element of, it's not a systematic and sustainable thing. And so if I had the option of investing in a company that had the internal management innovation capabilities to create wealth on an ongoing basis in a sustainable way, I'd want to invest in that company, because I will expect that for my retiree superannuation members, that they will get a level of wealth creation in their funds, in their superannuation retirement funds, on an ongoing basis. And so I'm looking for companies that have this capability. And at the moment, my assessment is that pretty few companies do have those capabilities. Let me continue to share screens quickly, and then we'll slowly wind down this episode. So recapping, ongoing wealth creation is about the deliberate combination of strategic, growth, operational, tactical actions that cause the value of the firm to be higher than what was expected today, so in this next period, and then the following period, on and on and on. I think you get the idea. Let's move on to the next slide. So given that if the governing objective is ongoing wealth creation, if that's primarily what we're trying to do here, and importantly, it's ongoing wealth creation in ways that enhance the well-being of the individual, the wider community, and the environment, because my fundamental proposition is that under the new paradigm, that's the only way to do this. That's why I say that. Then you're going to want a number of things. You're going to want a strategic planning process that is deliberately geared towards enhancing the value of the firm, right? because that's what we're doing here, is we're enhancing the value of the firm. So you need a value-based strategic planning process. And I've seen quite a few strategic planning processes, and pretty few of them have any real reflection to anything that I would describe as being fit for purpose in the game of systematic ongoing, wealth creation. So you need a value-based strategic planning process. You then need to be able to allocate resources based on the strategy that is in play at any point in time. And a strategy-based resource allocation process is fundamentally different to traditional mainstream, budgeting, planning, top-down target setting processes. It's fundamentally different to that. You need a performance management process framework to make sure that you are on track in delivering both the strategy and the financial performance embedded in the plan. And then you need an executive reward system that's focused on rewarding for the outcome, ongoing wealth creation. I'm going to do a whole video on executive reward in about 3-4 videos time. And I've got a lot to say about executive reward because I've done a lot of work on it. And at the moment, it's a shambles. And there's a real simple solution. In fact, let me just quickly, I'm not going to preempt the entire executive reward video, but let me just say that current approaches to executive reward, which is highly leveraged, share-based, plans and very complicated short-term, long-term, base short-term, long-term incentive, short-term incentive. It is so tangled and so convoluted that it is actually part of the problem that is driving really, really bad behaviors in corporates. And this is really the tail wagging the dog, and it needs to change. It's a simple change. Stay tuned, because in a couple of episodes' time, I'm going to deal with this really important topic. Let me just get back to sharing screens quickly. Got a few more slides, and then we can wind this episode down. Okay. So there are a number of characteristics that top performing companies that are gearing towards ongoing sustainable wealth creation will need to have. They will need to have the characteristics. You can measure them in relation to board governance, the extent to which their strategic management processes are fit for purpose in terms of a systematic, structured approach to ongoing wealth creation. There are a whole bunch of attributes around operational effectiveness, but the operational effectiveness aspect needs to be in the context of being effective in the operation or the execution of the strategy, not in its own right, independent of strategy. Okay. So the board aspect is, how do I set the conditions necessary for success to create wealth on an ongoing basis in ways that enhances the well-being of the individual, the wider community, and the environment. And it's not just about governance, folks. There is a governance aspect. It's not just about compliance. There is a compliance process, don't get me wrong, but it's way more than that. And boards really need to step up to the plate. So that governance process needs to drive into and dovetail into a structured strategic management process. Operational effectiveness is the slave to strategy, not the master. Here's the thing. There's a lot of work that needs to be done on culture, leadership, so people, processes, systems, structures. There's a lot of work that needs to get done on that level. And the fundamental answer to the question is, how do you create wealth on an ongoing basis? The fundamental answer is through innovation, creativity and innovation. And so a lot of organizations have a system and a culture based on compliance and command and control that just sucks the life out of innovation. And that's why way too many firms try to solve their innovation problem through acquisition, because they simply don't have the capabilities internally to do it themselves. And that's a real problem. So if I was to do a scorecard on where I think, and this is not evidence-based, this is, call this Marvin's hypothesis or Marvin's intuition, the aggregate scorecard on each of these dimensions. And if we define a range from, I'm not going to define this top range as best practice, right? Because the problem with best practice is you look at all the practices out there, and then you find out, what's hypothetically the best. But my proposition is that, the best, I'm going to say the required practice on each of these dimensions, my proposition is that in the vast majority of cases, we simply cannot or do not observe it. So if I was going to be generous, I would give board governance across the aggregate of, every company on the planet. At best, I'd give them a middle ranking. And I think I'm going to be a little bit generous, because I actually think they're quite a ways to the left, some ways to the left of a middle ranking. I've seen a lot of strategic management processes within a bunch of companies, and to be honest, they are a long way away from even being, a middle ranking. There's a lot of work that needs to be done in putting together a systematic, structured approach to, strategic management as the foundation for ongoing wealth creation. Operational effectiveness, yeah, a lot of organizations are really good at operations, and particularly over the last, dozen to 10 years, 10 to a dozen years, a lot of work has been done around what's often termed digital transformation. So from an operational effectiveness point of view, they're doing sort of reasonably well. But the problem that I've got is that a lot of the digital transformation and operational effectiveness improvement initiatives are done from the perspective of, improving operational effectiveness per se, but it's not within the context of the bigger picture, right? So again, there's still quite a bit of work to be done. On culture and leadership, there is so much work to be done. The vast majority of organizations that I've seen they have a toxic culture, particularly from, the mid-level senior executives down to senior management. And the HR professional has a lot, the HR profession has a lot of work to be done, has a lot of work to do in order to put in place the culture and leadership characteristics within an organization that, here we go, can then enable a systematic, organization-wide innovation, creativity, culture, because that's what ongoing wealth creation is all about. So I know I'm being a little bit harsh, but my point is that there's a lot of work to be done. There's a lot of opportunity for improvement, and institutional shareholders, in my view, should be advocating to the board, the chair, demanding that they move the dial on these things and other things, which I'll introduce to you later. So last slide, second last slide. So up until now, I've been talking about wealth creation in a fundamental, ongoing sense as a result of strategic actions, and that's what we really need. That's the operationalization of it there, sorry. What do we actually observe? So in a capital market sense, we can measure wealth creation in the capital markets by constructing an index, by deducting the cost of equity from the total shareholder returns that we see in the market. And so So that's the vertical axis, is a measure of observed wealth creation as measured in TSR less the cost of equity, because I've said before, the cost of equity is the benchmark of shareholder returns. So, if you drive a TSR equal to the cost of equity, you're wealth creation neutral. If it's greater, you're creating wealth. If TSR is less than the cost of equity, you are destroying wealth. So what do we observe? In this orange curve, I am plotting the aggregate TSR for the 50 largest non-resource, non-financial services companies listed in Australia, and that have been continuously listed in Australia over the period from 2000 to 2020. Right, so it's a 20-year time series of wealth creation. I've created a portfolio of the top 50 of these non-resource, non-financial companies, and this is what we see. Right, and so there's a couple of interesting observations, and each one of these is measured over a 1-year measurement period. All right, and then the dotted curve is fitting a polynomial line of best fit through the individual 1-year wealth creation data points. So there's a couple of observations about this. One is that just bear in mind that this is a portfolio of 50 companies. All right. So every time you construct a portfolio like this, you kind of average things out. So if I plotted this for any one particular company, the level of volatility will be much higher. So the first observation is that wealth creation, as measured in the capital markets, is highly volatile. And that's a problem. And I'm going to address that in a different episode. But let's just observe that it is highly volatile. And for one reason or another, what that says to me is that there's a lot of overshooting and undershooting going on within the capital markets. So, very small changes create very in sentiment or perception, but sentiment creates large swings in share price movements well in excess of what one would expect if the capital markets were operating in any kind of a rational basis based on fundamental, intrinsic economic expected outcomes. The other point to make in this is that very few companies, and so this is a aggregation of 50 companies, but if you go to an individual level, very few companies are able to sustain positive wealth creation outcomes for long periods of time. And what that says to me is that very few companies have in place a systematic, structured approach to ongoing wealth creation. So, it's like they surge forward, they pause, they go backwards. They surge forward, they pause, they go backwards. And so what we're needing is an ongoing sort of march forward. So I hope that's helpful. This is going to be a real foundational video. Please like, share, subscribe to my YouTube channel. Just go onto YouTube, search for Valuation Insights. It's really important that as many boards and senior executives as possible can view this, understand the content, and then start thinking about what does this mean for my organization. And for those people that are really forward thinking, so business leaders, people of influence that are really forward thinking, one of the best things that you can start thinking about is, how can I use this emerging nascent understanding? How can I use this to be part of a global movement to create the conditions for this global transformation for the benefit of all of humanity? That would be a legacy worth shooting for. And philanthropy is great, but if you have the resources and you want to create a legacy, a real lasting legacy, get on board with this. Please get in contact with me. It's easy to find out how to get in contact with me. We've got a lot of work to do. I look forward to all of your participation. Thanks for watching. Look forward to catching you next time, and bye for now.